So the second concept here, still on basic certainty models, is number 2, multiple product CVP. Multiple product CVP. Where we've said it is where you're producing more than one what? Product. More than one product. When you're producing more than one product, you introduce the concept of weights. You introduce the concept of what? Weights. That is what you introduce. The weights here may be the current sales ratio of the product you are selling or any other. So the weights is what you introduce. Otherwise, the formulas tend to be there. They tend to be the same, apart from this introduction of what? Weights. For example, to determine your weighted contribution margin ratio, or your contribution margin, say your weighted contribution margin here, which is going to be used to determine break-even point in shillings. And it is also going to be used to determine your profit in shillings and also your target profit, your target profit in units, your BEP in units. You determine it by taking the weight, the summation of the weight, times the contribution margin. The summation of weight by contribution margin. The summation of weight by contribution margin. Let me write this. It is the summation of weight times your contribution what? Margin. The weight of each product times the contribution margin of each product, then you get the the totals. Sorry, or excuse me. The other item we want to introduce is your weighted average contribution sales ratio, contribution margin sales ratio. Which is given by the weight contribution margin sales ratio. Again, the weight of each product by the contribution margin sales ratio of each what? Product. Number 1, to get your break-even point in units, you simply say it is your fixed cost, but now you're going to use your weighted average contribution margin to determine your break-even point in shillings. You're going to determine it as your fixed cost divide by your weighted average contribution margin sales ratio. Then that is number 1. Number 2, if you want your profit, you can say it is simply your contribution margin of your first product by the units of your first product times the contribution of your second product by the units of your second product, all the way to the contribution of all the products that you are producing, minus your fixed costs. Minus your fixed cost. Or you use the contribution margin sales ratio, contribution margin sales ratio of your first product by the revenue of your first product plus contribution margin sales ratio of your second product by the revenue of your second product plus the contribution margin sales ratio of all the products by the revenue of those total products minus your what? Fixed cost. Minus your fixed cost. Number 3 is that margin of safety is not changing. Margin of safety is not going to change. You're simply going to say it is your current sales minus your break-even point. Number 4, sales, target sales to earn a given profit. To earn a given what? Profit. To earn a given profit. To earn a given profit, what will you do? You're going to say, if you want it in units, it is going to be your fixed cost plus your target profit divide by your weighted average contribution margin. If you want it in units, in shillings, in units we have already written, it is going to be your fixed cost plus your target profit divide by weighted average contribution margin sales ratio. Divide by weighted average contribution margin sales ratio. We then can now do a question. December 2024. Question 4. Agrovet Group. The question states, Agrovet Group is a multi-divisional agrochemical firm that deals in multiple products. Delta Division, one of its subsidiaries, makes 3 products branded Betax, Zite, and Alpha. The management is contemplating changing the sales mix in scenario 1 to a new sales mix in scenario 2 in order to maximize the net profit. The 2 scenarios are envisaged as below. Scenario 1, the sales costs and output data for the original sales mix for the year 2024 for the 3 products is as follows. You have your sales mix, your selling price per unit, your variable cost, your total fixed cost, and your total sales revenue. Scenario 2, Agrovet Group sales, estimated sales cost and new sales mix as follows. Your sales mix, your selling price, your variable cost, your total cost, and your total sales. Management performance measures are based on cost volume profit analysis. The weighted average contribution margin ratio of each scenario is determined based on its sales mix. Compute both the break-even point in sales revenue and the profit for each. By comparing the break-even point and net profit, advise the management of Agrovet Group whether it is worthwhile to change the sales mix. All right. So let's start by analyzing what we've been given. We have 3 products, which is Betax, Zite, and lastly Alphas. Your selling price P is how much? 2,000. A variable cost of 1,000. So that your contribution margin will be 1,000 and your contribution margin sales ratio is 0.5. 0.5. Zite, your selling price is 3,000 with a variable cost of 1,800. So that is 1,200. That should be 0.4. 2,500. 1,500. That is 1,000. 0.4. This is scenario 1. This is scenario 1. Scenario 1. Here, that is scenario 1. Scenario 1. Your total fixed cost in scenario 1 is 15,664,000. Your total revenue is 45 million. Is 45 million. 45 million. Then first part of that question, compute both the break-even point in sales value and net profit for each scenario. For each scenario. Let's get the break-even point. To get your break-even point in units, say it is your fixed cost divided by your weighted average contribution margin. And your weighted average contribution margin, you're going to take it as the weight times the contribution margin of each product. And they're saying the sales mix of B-tax is 0.4 by the contribution margin of 1,000, the weight of ZT of 0.3 by the contribution margin of what? 1,200 plus the weight of alphas 0.3 by contribution margin of how much? 1,000. By contribution margin of 1,000. So therefore, your total contribution margin, will be 1060. 1060. Right? So therefore, your break-even point, you're going to take what? 15,664,000 divide by 1060. 664,000 divide by 1060. That should give you 14,777.36 units. 0.36 units. To determine your break-even point in shillings or in sales, you simply take your fixed cost, divide by weighted average contribution margin sales ratio. Your weighted average contribution margin sales ratio, you're going to take the weight by the sales ratio. The weight was provided as 0.3 times your sales ratio of 0.4. The weight, which is the current sales mix in the question, of 0.3 times your sales ratio of 0.4 times 0.4. So that should give you 0.44. So therefore, your fixed cost in scenario 1 was 15,664,000 divided by who? 0.44. So in shillings, that should be 35,600,000 what? 35,600,000. Scenario 2. We analyze scenario 2 here. We want to analyze scenario 2. Scenario 2. You have your first product, betax, then zeta, then alphas. Your selling price, your variable cost per unit, your contribution margin, and lastly, your contribution margin sales ratio. Your selling price is 2,000, of betax 1,000, contribution is 1,000, that must be 0.5. Zeta, your selling price is 2,800, variable cost of 1,680. The contribution margin sales ratio will be 1120 divided by 2,800, which is 0.4. Alphas, this is 2,500, that must be 1,000, that must be 0.4. Your fixed costs is 15,664. Your revenues are expected to be 45 million. They are expected to be 45 million. BEP, units, it is your fixed cost divided by your weighted average contribution margin. So let's determine our weighted average contribution margin. We're going to take the weight. The weight is changing now in scenario 2 such that the sales mix is 0.5 by who? 1,000 plus 0.3 by 1120 plus, this should be 0.2, not 0.3, 0.2 by 1120 plus 0.3 by 1,000 times 1,000 times 1,000. So 0.5 times 1,000 plus 0.2 times 1120 plus 0.3 times 1,000. That is 1024. That is 1024. So therefore 15,664, which is our fixed cost, divided by 1024, 15,664,000 divided by 1024 means for that company to break even in units, they need to sell 296.875 what? Units. They need to sell those number of units. Break even point in shillings. It is your fixed cost divided by your weighted average contribution margin sales ratio. How do you get your weighted average contribution margin sales ratio? You simply take your weight of 0.5 by your sales ratio of 0.5 plus weight of 0.2 times 0.4 plus 0.3 times 0.4. So 0.5 plus 0.2 times 0.4 plus 0.3 times 0.4. That should give you 0.45. So 15,664,000 divided by 0.45. That should give you 34,808,888.89 shillings. 0.89 shillings. Part 2 of that question. And they also still in part 1, they're asking compute both the break-even point and the net profit for each scenario. So let's get the net profit. Let's go back to scenario 1. Net profit. You're going to say it is your weighted average contribution margin sales ratio. You multiply by your revenue minus your fixed cost. Minus your fixed costs, 0.44. Your total revenue was 45 million minus fixed costs of 15,664,000. 41,36,000 shillings. So that company will make a profit of how much? 4.1 million. Then the net profit in scenario 2, again you take your weighted average contribution margin sales ratio, you multiply by your total revenue minus fixed cost. Your sales ratio was 0.45 times 45 million as your revenue minus fixed cost here 15,664,000. 45, 86, 4.5, 86,000 shillings. By comparing the break-even point and net profit, advise the management whether it is worthwhile to change the sales mix. The current break-even point in shillings is 35,600. The other one is 34,808. The net profit of this company is 41,36, and this is 45,86. 45 what? 86. Therefore, what will you advise them? If you use the what? The break-even point as your basis of decision making, you're going to tell them to do what? To have the new what? Product. To have the new product ratio. So using the break-even point, you will advise them to do what? To have a new sales mix, or to take scenario 2. To take scenario 2. Why are you doing that? Because the break-even point in scenario 2 is lower than the break-even point in scenario what? 1 in shillings. In shillings, it is way what? Lower. Now, the net profit here, the net profit in scenario 1, that is 41,36. In scenario 2, it is 45,86. So what will you tell them? You're going to take the second what? The second what? Ratio, or the second scenario. Why? Because it has a higher what? Profit. It has a higher profit. It has a higher profit. So in both cases, you're going to tell them to change to scenario 2. You're going to tell them to change to scenario 2. So in both scenarios, you've agreed that you choose scenario 2. So you change the ratio or the sales mix to be 0.5 is to 0.2 is to 0.3 is to 0.3. Now, sometimes a student may ask, why is it that we are choosing scenario 2 instead of scenario what? 1. We are choosing scenario 2 instead of scenario 1 because it has what? Less shillings. That means any extra shillings above 34,000 is a what? Is a profit. Any extra amount above 35 million is also a what? A profit. It is a profit. Alright, so you choose scenario 2 because it is the one with that will generate a break-even point in shillings very fast at 34 million compared to 35.6 million in scenario 1. Now, alright, so now that we have done multiple product, remember this is multiple product. It is multiple product, so this should not have been here so that it doesn't confuse you. That is multiple products. I will leave you an assignment that you can attempt in your own free time, which is April 2022, question 1D. April 2022, question 1D is the assignment I will leave you to attempt in your own free time. And please remember to attempt those questions. They are practice questions, and this being a mathematical unit, it is important you attempt them for your own what? Practice. For your own practice and understanding. That's being single and multiple product under certainty models. I wish that we end it at that. So in the next lesson, we are going to talk about certainty, uncertainty models of CVP. What we've discussed today is certainty models, where we've said is where the factors that affect CVP are known and by the user with certainty. Factors such as demand, factors such as selling price, factors such as variable cost. When you know them in certainty, we refer to that as certainty model of CVP. Where you are uncertain, we refer to that as uncertainty model of CVP, which is what we will discuss in the next lesson. All right. So until we meet in the next lesson, from my behalf as Bernard Mariga and on behalf of Manifested Publishers, I wish you a good time and God bless you.